Hello, this is Fred Paine with Private Family Banking Partners. Thank you for joining us in this presentation of how to build wealth and keep it. Wealth isn't measured by how much money you make. Wealth is measured by how much you keep. This principle is well illustrated by the Rothschild family. And although there might be a lot of negative connotation associated with this family, they know how to build and keep wealth. The patriarch of the family, Mayer Rothschild, was a banker. He died in 1812, and not only did he leave a sizable inheritance to his descendants, he left them a three-part family wealth management system in place, a banking system, if you will. This system looked like this. The family's wealth was to be kept together in one family bank. Number two, the family could take a loan from the family bank, but the loan needed to be repaid. And number three, once a year, the family met together to share the lessons that they learned, the things that worked to make money, the things that didn't work. And if they didn't do these three things, they were out of the family bank. Today, the Rothschild fortune is estimated to be somewhere between $1 and $100 trillion. I've heard some estimates put that as much as $500 trillion, which is half of the world's money supply today. They know how to make wealth. Tonight, I want to share with you how we can utilize some of these principles to build wealth for ourselves. The average American makes more than $1 million in his lifetime, but we just don't keep it. For example, if a person earns $50,000 a year and saves it all, and if he could grow that savings at just 5% a year, over 40 years he will accumulate over $6 million. So here's $50,000 a year in income. And over 40 years, if he doesn't use any of that, none of it goes away, he's accumulated over $6 million. But this person has to pay taxes. And taxes is one of the wealth stealers in our society. Let's say this person pays 28% of his $50,000 a year in taxes. Well, that leaves him with $36,000 after taxes. And this chart illustrates the difference that makes over the 40 years of wealth accumulation. But then the person spends some of that money. He's got to provide for his family. He has to provide for transportation. He needs housing. He needs groceries. So let's say he has to spend 90% of his after-tax money on those necessities. Well, this little blue bar is what is left. That's the 10% that he's saving and trying to cause to grow. It's a losing proposition. We can't get there from this kind of proposition. So what do? Well, most people think that in order to get ahead of this game, we must do one of three things. We must work harder, we must stop spending, or we've got to take on more risks. But sometimes we can't work any harder than we do. There's only so many hours in a day, and we can only work so many of those hours on a regular basis. So it's not about working harder. We can't stop spending because we've got to provide for our family's needs, as we've just talked about. And so that leaves us with taking more risks. But is that really the answer? Well, let's try to answer that as we look at three different ways to view money. We can view money as a spender, as an investor, or as a banker. Let's take a look at how a spender looks at money. He sees money as a way to buy things. But every purchase costs him interest. The borrower pays interest to whoever he borrows from. The cash buyer saves up his money and then liquidates that and purchases what he needs, and he gives up the interest that money could have earned over time. Either way, the spender never builds up any wealth. What does that look like? Well, let's use the example of buying cars. There's 3 ways to buy a car. We can borrow the cash, we can save up and pay cash, or we can use the private family banking system. Let's say we purchase a car for $30,000. Now, when we're younger, we may purchase a car for less than that. As we grow older and hopefully more affluent, we may purchase a car that costs more than that. But let's assume that the average of all the cars we buy is $30,000. If we finance those cars at 5.5% interest, which is a modest amount, and we purchase a car every 5 years, after 11 purchases, the borrower has spent $378,203. The cash buyer maybe has been a little bit smarter by saving the interest he would have paid. He pays $330,000 for those cars after 11 purchases. And after 55 years of doing that, the difference is only $48,200. You'd think that it would have been more significant than that. Well, let's take a look at what the banker does over the same period of time. The banker, who didn't make the car, he didn't sell the car, he didn't transport it to the dealer, he didn't buy the car. All he did was act as the middleman between the person who was accumulating the cash and savings and paying cash for it and lending that money to the borrower who was gratifying his desires and needs right away and borrowing the money to pay cash. And what does he make over this same period of time? He makes $380,820. Wow. The banking business is a very lucrative business. It's a good way to build wealth. And that's why people spend a lot of energy, a lot of time, and a lot of money to build a bank. They've got to get a bank charter that takes a number of years and a large accumulation of money. Then they've got to build a building. They've got to hire staff, start taking deposits, and lend those deposits to borrowers. Well, what if you could take over that function for yourself? We're going to see what that will look like. But first, let's take a look at another graph. This is what it looks like. Let's say the borrower is buying a more modest car, a $20,000 car. So he goes to the bank and borrows $20,000. And after a year, he pays back $5,000 and he owes $15,000. The next year, he owes $10,000. He owes $5,000 after paying for 3 years. And then finally, he pays the car off. And then what? Well, now it's time to go get another car, isn't it? So he starts the process all over again of going into the hole, borrowing to buy the car, paying it back, and over his lifetime of buying cars, what's he left with? He's left with one old car and no money. The cash buyer maybe is a little bit smarter. This is what I was taught. Save your money and pay cash so you don't have to pay that interest. And so he saves his money and accumulates $5,000 the first year, another $5,000 the next year. He has $10,000. Next year he's got $15,000, and finally he saves up to $20,000, and now he liquidates it and buys his car. He's back to zero. And isn't it wonderful now he doesn't have a car payment? Well, yes, he does. Because if he doesn't start saving for the next one, to where he's got $5,000 the first year, $10,000 the next year, $15,000, and then another $20,000 so that he can buy the next car, he's going to be on the red graph down below. He'll become a borrower. So he does still have that car payment. And at the end of his lifetime of purchasing cars, he's at the same place that the borrower is. He's paid a little bit less interest, but he's left with one old car and no money. Contrast that with what the private family banker does. There's the red borrower and the blue indicating the cash buyer. But look at what the green does. He slowly starts to accumulate money as he banks on himself, and over time he accumulates a significant amount of money, so that at the end of his lifetime of buying $20,000 cars, he's got over $200,000 in an old car. So being the private family banker is the way to purchase. Let's look at what the investor, how he views money. The investor views money as a way to buy things that he hopes are going to go up in value, and that he hopes he can find someone to buy when they do. But every investment exposes him to another wealth stealer, and that stealer is risk. And every gain he makes costs him taxes. This is what the investment risk game looks like. Imagine you have $100,000 that you invest, and it goes up by 10% the first year. Now you've got $110,000. And then the next year there's a downturn and you lose 10%. You might say, well, at least I'm back to even. But that's not true, because 10% of 110 is 11,000. You're down to 99,000. You're not even. And if you go the other way around and lose 10% first and then gain 10%, you're still not even. You're still at $99,000. Look at the next chart, which shows how much is required for you to break even after a loss. If a person loses 20%, he's got to gain 25% to recover and break even. If a person loses 40%, he needs a gain of 67% to break even. A 50% loss requires a 100% gain just to break even. And if a person loses 100%, well, they're broke. No amount of gain is going to do you any good. You're going to have to go back to work. So risk really is a wealth stealer. That's why Warren Buffett's first rule of investing is never lose money. And the second rule is the same. Never lose money. It's too hard to make it up. So that's what the spender looks like and what the investor looks like. What does the banker look like? Well, the banker views money as a way to make money. Every purchase is an opportunity to gain, and the banker always keeps his money working, earning compound interest. It's purported that one time Albert Einstein was asked what the most powerful force in the universe was. And rather than saying nuclear fusion or fission or even gravity, he answered, it's compound interest. That's interest that earns accumulated interest over time. I like to call it the wealth curve. It may start off slowly initially, but over time, that compounding interest grows exponentially. But the cost of falling off this wealth curve is fairly significant. Say a college student graduates and saves up money for 5 years, and at age 27 buys a car. He falls off the wealth curve. And by the time he's age 80, that one time falling off the wealth curve has cost him $400,000 in the potential accumulated cash. And not only does he fall off one time, but we fall off the wealth curve time after time after time. Every purchase, you see, costs us interest. We either pay up and buy stuff immediately, pay interest to someone else, or we give up the interest that our money could have earned by liquidating it and making a purchase. Well, what if we could use our own money without giving up the interest that it could own? Private family banking allows you to become that middleman, to become your own bank. We can show you how to get on the wealth curve for the rest of your life. How do we do that? Well, we do the same thing that a bank does. What does a bank do? It takes deposits, it lends money, and it earns interest by keeping its money working. So starting a private family bank, your own bank that you use exclusively for yourself and for your family, is all about creating a pool of money, a pool that is guaranteed to grow, that is safe, and that's liquid. We put that money to work, earning interest, compounding, and we use the pool of money as collateral whenever we need cash. Let me ask you this question. If our money was earning 4% interest, would it make sense to borrow the money at 6%? Well, we intuitively all answer no. It's better to liquidate it. But is that true? Look at this chart. Let's talk about purchasing that $30,000 car over 5 years, 60 payments at 6%. Our monthly payment is $580. When we're finished, we will have paid $34,799 for the car. $30,000 for the car, $47.99 in interest. If at the same time our money is earning at 4% interest, the accumulated amount of money that we'll earn is $36,630. We do come out ahead. What's the reason for this? Well, we're paying interest for that car on a decreasing value every month, while we're earning interest on an increasing amount every month. We're compounding. Well, what if we could take over this banking function and charge ourselves 5% for this $30,000 car, and we were earning 5%? Well, that's exactly what's going on within the insurance policies that we customize for people. Well, look at the amount of accumulation of cash value we have now. It's $38,501, and we've only paid $33,968. So that's what, almost a $4,500 difference. That's a significant amount of cash accumulation. And the interest that we're paying eventually ends up back in our own money pool anyway. So there's 3 ways to put our money to work. We're told we should put our money into the stock market. Well, the stock market goes up and the stock market goes down. And while we can make money in the stock market when it's going up or when it's going down, we better know what we're doing, and we better be paying close attention. And the timing of the stock market, in order to make money this way, takes a lot of luck. So perhaps the stock market isn't the best place to put it. Buy and hold really doesn't work anymore. Some people say the best place to put our money is in real estate. But a number of my neighbors here in Phoenix are upside down on their mortgages, especially after 2010 when the housing bubble burst. So perhaps the real estate market is not the best place to store our money. Besides, it's not very liquid in that place either. So that leaves us with financial instruments that have guarantees. What are those financial instruments? Savings accounts, CDs, and insurance contracts. Savings accounts and CDs right now, that's like putting your money under the mattress. Insurance contracts are paying about 5%. So if we were to list the ideal objectives that we wanted for our money to be able to grow, what would we want? What would we look for? Would you like to have no risk involved with your money? Oh, that's a resounding yes. Would we like guarantees? Would we like no penalties associated with the money? In other words, would we like to start using it before we're 59 and a half without a penalty? And would we like not to have to use it after we're 70 and a half without a penalty? Well, yes is the answer to those. Would you like to get your money whenever you need it? Would you want your money to be liquid? Would you want your money protected from creditors? Yes, absolutely. Would you want to create the most amount of wealth using the least amount of money? Would you want leverage? Would you want your money to grow tax deferred? Would you want your money to be tax-free upon distribution? Absolutely. Would you want your money to be available as collateral for loans? Sure. Would you want your money to be tax deductible when you put it in? Now, we all say yes to this, but the Government Accounting Office says it's going to collect $1.15 trillion in 2013 in taxes, and in 5 years that amount is going to increase to $2.5 trillion. Wouldn't it be better to pay taxes now when you know what the rate is than to wait and see what it's going to be, and it's going to be higher later on? Well, yeah, so maybe the answer to that should be no, even though we initially are all going to say yes. If you became sick or disabled, would you want someone else to continue to put money in? Would you want a disability benefit? Sure. Would you want this money to be transferred to your family or heirs tax-free? The answer to all of those questions is yes. So let's compare the components of what we want with programs that we've already been funding. Look at this chart that I call the money matrix. Across the top you see IRAs and 401ks, brokerage accounts, our homes, CDs, bank savings, annuities, real estate, and then our answers, which are all yes. And then we see the questions that we answered down the left side, and look at all of the red no's. Some have maybes in there, a few yeses, but in general, the things that we're putting our money into don't get us what we want. Is there an instrument that we can use to get us what we want? Yes, there is. At Private Family Banking, we use the same financial instruments that banks, large corporations, and very wealthy people use to park their money. It's a place that's safe and where they can get guaranteed growth. The FDIC recommends that banks buy bank-owned life insurance, or BOLI. And they do. Most banks hold this. They don't tell us that that's what we're supposed to do, though, because they understand that permanent whole life insurance is a safe, liquid way to hold and use capital. What we do that's different at Private Family Banking Partners is we'll customize your life insurance policy so that it gives you liquidity, safety, guaranteed growth, protection from taxes, and protection from judgments and lawsuits. This next chart shows what typical insurance policies look like. In the red, we see a term policy illustrated. It gives us the maximum death benefit for that term period, but after that period of time is over with, that same amount of death benefit is going to cost us more money, and there is no cash accumulation in a term policy. The blue shows us the typical whole life policy that most financial gurus advise people against. It doesn't grow much in the first few years, but after a while it starts to grow, and it does eventually accumulate some cash that you can start using. With a Private Family Banking optimized whole life policy, we see what happens on this green portion of this chart. We optimize policies to build cash immediately, cash that you can start using right away and that grows exponentially over time. We get you on the wealth curve. If you can control your own banking system, then you can capture the interest that you've been paying to someone else or that you've been losing by liquidating your cash. The average American spends about 20% of his income, after-tax income, on automobiles, about 30% on housing, about 40% on other living expenses, and he tries to save about 10%. The actual savings rate right now is a lot less than that. Of that amount of money, about 34.5% of it is going to pay interest, as illustrated by the yellow in this chart. You've been paying interest to others. And so if we can capture that interest for ourselves, then that 10% savings amount is going to grow and grow significantly. How do we do that? Well, now that you're the banker and you have a pool of money that you're growing, the premiums that you pay are like deposits that you put into the bank, except you own the bank. You're putting those premium deposits into a money pool and then using that money pool as collateral to purchase cars and then paying it back. You're paying off credit cards, or you're making purchases that you would have used a credit card for, and then you pay it back into the money pool. And as you keep doing this, eventually you're able to take over your own mortgage and start paying that mortgage payment back into your own money pool. My wife and I have been practicing this system for 5 years, and we're at the point where we can now take over our mortgage. And the payments that we made to Bank of America, we're now making back to ourselves. So how would your savings change if you could recapture the money that you've been throwing away in interest? It would look like this. Instead of 10% savings that you're trying to grow, you'd have a 45% increase, which is a tremendous return on investment. So most people are on this chart, where most of the interest is falling below the zero line, and we're trying to grow our savings into some kind of sizable amount. What we want to do is put you on this chart, where you've become your own bank and you're recapturing the interest that was floating out of your life. There's several ways that you can utilize the private family banking system. We've helped people to become debt-free. We've helped people establish a good retirement plan. You can pay for college. You can finance a business or equipment. You can build multi-generational wealth with the private family banking policy. Well, thank you for attending and listening to this presentation. We'd be happy to give you a free financial consultation and show you how you can start building your wealth and keeping it. Just give us a call, or give my partner who gave you this presentation a call. You can reach me at privatefamilybanking.com, or give me a call or give me a text. Here's my contact information. Thank you again for listening to this presentation. God bless.